Hi, in this part of the course, we're going to talk about capital budgeting. So first of all, what is it? It's the assessment of potential projects and investments that a business or a corporation is facing. And it's part of firms' very important, very critical capital allocation process. So first of all, what is capital? Sometimes people use the term interchangeably with money or wealth, but there is actually one very important distinction. Capital is cash or assets, other assets that are needed to produce goods or services. So it's being put into productive use, right? So it's not money under your pillow, for example. It is, again, put into production or put into services. So it's being invested with the primary purpose of generating more wealth as a result of that process. So, as I said, capital budgeting is part of the capital allocation process. And remember that capital is very precious, right? We saw in earlier parts of this course when we were talking about stock valuation, for example, the cost of capital. The numbers we used were pretty high numbers that the cost of capital that companies were facing, and then those were the discount rates we use in, for example, enterprise the valuation, and now from there stock valuation. So capital is very precious. So the shareholders, the owners of the business, they are depending on the management of those businesses and corporations to use that capital very prudently to make very, very good decisions with that. So there are three pillars to the capital allocation process. The first one that needs to be done first, and also the most important one, and the topic of this part, of course, is the investment decision. So that's what we are calling capital budgeting. So to budget this precious capital and to make good investments with those. So the big question is, what is a good investment? Right? So that's what we are going to be studying. What makes one project or investment good versus another that's not as good? And remember, the purpose of for-profit businesses that we discussed earlier in the semester, we said the purpose of any business, for-profit business, is to maximize the wealth of their owners, right? To maximize the value of the firm and thereby the wealth of their owners. That's what those owners are counting on, and that's why they invest in the first place. So the same principle applies to investments. That's the main criteria that we're going to use. That is, any project that's taken must also fit with that purpose, meaning that it must increase the wealth, it must improve the value of the company, increase the value of the firm, and thereby the wealth of the owners. We're going to call this net present value, but that will come in a little bit. Now, this is going to be our main topic in this class, the investment decision, capital budgeting. And this is not just important for corporations, but this is also important for small businesses. They have to deal with these issues, capital budgeting issues, the investment decision all the time, and even for individuals. So hopefully you're going to take out of this, things that we're going to discuss in this part of the course. Hopefully you're going to be able to apply some of those lessons in your life going forward. So for example, what you're doing right now, what you're doing in college, is investment in your human capital. So hopefully it's worth it. But how do you assess it? How do you evaluate that? So the tools that we're going to learn and the principles we're going to learn will hopefully shed some light on your individual decision making as well. So this is our main focus, the investment decision, but we're not going to stop there. Later on, for future finance classes, if you are a finance major and if you take other finance classes, we'll get into details of the two other pillars of capital allocation. So let me touch on that a little bit, what those involve. One is the financing decision. So when the company makes the investment decision, so capital budgeting is done, and we're going to learn how that's done. Now, the next question is, how will those investments projects be financed, right? So in some rare cases, companies will have enough cash or enough profitability to not need external financing. So they will be able to sustain themselves just using the cash flow that they are generating in the business. But if that's not the case, if this internal financing is not sufficient, many companies will have to raise external financing. And then the management is facing a question about, okay, let's say we need this much for this project, which according to our investment decision, capital budgeting, it looks like this is a very good project for us, so we should do it. It's going to increase the value of the firm. How should we raise this required financing? And then some of the choices you face will be, should we borrow? If we borrow, should it be a loan? From whom, which institutions? Or should we go to the bond market? If it's a large corporation, the bond market might be an option. Or should we forget about borrowing? Maybe we don't have enough cash flow to make those interest payments in the short term. So maybe we should raise equity by maybe going public. Or if we are already public, maybe by issuing a seasoned equity offering. Or if we are private, maybe raising some private equity. So selling some chunk of ownership to outside investors. So that's the financing decision, and that's one of the very important decisions, responsibilities of, say, the chief financial officer of a corporation. And after that, some businesses will be in the enviable position of having enough cash flows that they need to make a decision about what they are going to do with all that excess cash. So think here about, for example, the Apples and Microsofts and Googles of the world. So they are sitting in this huge cash balances, and they are generating even more profit all the time. So they need to make some decisions as to what they are going to do with that cash. Investors invest in these businesses pursuing profits, right? Pursuing and return on their investment. So as we saw earlier, one way they can generate some return, those investors, is going to be by the company sharing some of their profits with those investors. So not just the increase in the value of shares, for example, but cash flows coming from the company to the shareholders. For example, paying out dividends or engaging in share purchases, repurchases, or the buybacks, which we had talked about earlier. And some companies will say, actually, they don't want to distribute it. Cash is very precious. So some of them will want to build a certain amount of balance for use in the future when they need the money, for example, for a major acquisition. Then instead of having to go external financing, they may just use their cash balances. So that's the capital allocation process. But as I said, it starts, the first and the most important step here is the investment decision, because this is why these businesses exist, and this is why investors invest in these businesses through these profitable, productive investments. Company value, firm value increasing, and not just for the company, but this is very important for economies as well, because economies depend on private enterprises making very good decisions in this capital budgeting and investing in good projects that will generate wealth, that will generate growth at the economic level, and will improve the life quality of people within that economy. As important as capital allocation is, many businesses and management teams are surprisingly bad at it. There's a very nice link at the end of this chapter in the book, a report from Credit Suisse, a team at Credit Suisse about capital allocation. One of the authors, the main author, Michael Mauboussin, is a great financial thinker. He has many different reports on many different topics, and he's fantastic. So look him up. And I will also link this report just below this video. So check it out. It's a very interesting, sometimes it's a little bit at times too advanced perhaps, but it's worth checking out. And what I want to highlight from this report is, you can see it starts with capital allocation is a senior management team's most fundamental responsibility. Again, the goal is to increase firm value, and you do that by allocating capital prudently and effectively. The problem is that many CEOs don't know how to allocate capital effectively. The objective of capital allocation is to build long-term value per share. So again, to increase firm value. And then it goes on to discuss what are some of the best ways of doing that. As another example, another report that's linked on the textbook, which again, I will link it under this video, is a report by McKinsey, how to put your money where your strategy is. Most companies allocate the same resources to the same business units year after year. So that's one way businesses sometimes do things, is if they don't do a very careful capital budgeting analysis, they will exhibit some inertia, meaning that, okay, we invested this much in the business in the past year, maybe we're going to invest about the same. Everything went well, so why not invest about the same amount? So budget about the same amount. And that's absolutely not the right way to go about that. So this report by McKinsey is about that. That makes it difficult to realize strategic goals and undermines performance. Here's how to overcome resource allocation inertia. Okay, so another shorter resource that just go over and take a look and see what they recommend that CEOs and businesses do when allocating capital. So then what's the right way of doing capital budgeting? So we are going to discuss 4 methods. They are all very commonly used. So if you are ever involved in capital budgeting, capital allocation out there, whether it's a small business or a large corporation, you will probably hear at least one, if not more, of these. We're going to start with net present value and profitability index, which are very, very similar. And these are very, very sound, very good theoretically, very good ways of doing capital budgeting and assessing potential projects and investments. And then we're going to also talk about internal rate of return, which is also very, very common use, but it has some deficiencies that we are going to discuss. And then the last one, and the least effective and preferable one, is the payback period. It's used in certain very specific contexts, as the textbook discusses, but compared to the previous 3, it's not advised to use because it has some major deficiencies. For example, not taking into account time value of money or uncertainty, considerations like that. So we are going to primarily focus on net present value. That's what we will start with. And we're going to build on that with profitability index and internal rate of return, IRR. So let's start.